It's all about credit, how it can impact your life. You see, every single day, from the moment we open our first bank account or take out our first student loan, we're playing the credit game. But it's a game where the rules aren't always clear, and the stakes are sky high. Our financial future, from buying a dream house to zooming around in that shiny new car, is closely tied to this three-digit number called a credit score. So, today we're going to unravel the mysteries of the credit world piece by piece and understand how it can impact your life. We'll start at the very beginning, with the basics. Let's dive right in. First, let's tackle the basics. What exactly is a credit score and why should you care about it? Well, think of it as your financial report card, a grade that lenders use to assess your trustworthiness when you want to borrow money. It's a three-digit number that can range from 300 to 850, with higher scores being better. But why is it important? Oh, it's important because it's the key to unlocking financial opportunities. Your credit score determines whether you'll get that loan, rent that apartment, or even land that dream job. It's like a financial passport, and without a good one, the doors to your dreams can slam shut. Now let's talk about the secret recipe that goes into cooking up this credit score. There are 5 main ingredients. 1. Payment history, the most crucial factor. It's all about making payments on time, every time. Late payments can dent your score. 2. Credit utilization. This one's all about balance. You want to keep your credit card balances low relative to your credit limits. High balances can harm your score. 3. Length of credit history. The longer, the better. It's like seasoning in a recipe. The more years you have, the better your score. 4. New credit accounts. Opening too many new accounts in a short time can raise a red flag for lenders. 5. Types of credit. Used. Having a mix of credit, like credit cards and installment loans, can be a positive factor. Understanding these factors is like knowing the ingredients in your favorite dish. You can tweak them to make your credit score a masterpiece. Alright, so we know what a credit score is and we've seen the ingredients. But here's why it all matters. It's your golden ticket to financial stability and achieving your life goals. Think about it. Want to buy a house? You'll need a mortgage. Dreaming of that sleek car? An auto loan's on the horizon. And if you're an aspiring entrepreneur, financing your business might just be the stepping stone to success. But here's the deal. Without a good credit score, these dreams can remain just that, dreams. Lenders use it to determine your risk level. A high score means you're responsible, while a low score raises eyebrows. So, the better your credit, the easier and cheaper it is to achieve your financial goals. Alright, you've got the basics down, but let's get into the nitty-gritty. Credit scores come in different flavors, but one of the most common types is the FICO score. It's like the chef's special in the credit world. FICO scores range from 300 to 850. Now, it's time to learn what each range means in terms of credit worthiness. 300 to 579. Ouch! This is considered poor credit, and lenders might slam the door shut. 580 to 669. Fair credit. You might get approved for some loans, but with higher interest rates. 670 to 739. Good credit. You're a decent risk for lenders, so you'll likely get better terms. 740 to 799. Very good credit, now we're talking. You'll likely get the best deals. 800 to 850. Excellent credit. You're the rock star of the credit world. Lenders trust you and offer their best deals. Your credit score is only part of the story. To get the whole picture, you need to know about your credit report. Think of it as the backstage pass to your financial life. So, what's a credit report? It's like a detailed financial diary that lists your credit accounts, payment history, and even public records like bankruptcies. It's maintained by credit bureaus like Equifax, Experian, and TransUnion. The cool part? You're entitled to a free credit report from each bureau once a year. Simply visit annualcreditreport.com, and you can see what's in your report. It's essential to review it for accuracy and ensure there are no errors, as they can impact your credit score. Now, for all you young adults out there, this part is crucial. Building good credit habits early can set you up for a lifetime of financial success. Here's what you need to know. 1. Open a first credit card. It's like dipping your toes into the credit pool. Start with a secured or student credit card, use it responsibly, and you'll begin to establish a credit history. 2. Pay bills on time. This is non-negotiable. Late payments can leave a nasty mark on your credit report. 3. Avoid common credit mistakes. Don't max out your credit cards and don't apply for too much credit at once. It can hurt your score. Remember, building credit is a marathon, not a sprint. The earlier you start, the better. And even if you're not a young adult, these tips are still incredibly relevant. Now, for all the parents out there, your role in educating your children about credit is crucial. Teaching them the ropes can set them on the path to financial success. Here's what you can do. Start early. Introduce the concept of money and saving from a young age. Teach them about the value of responsible spending. Co-sign on a credit card. For your older kids, co-signing on a credit card can help them start building a credit history. But be cautious, as you're equally responsible for the debt. Educate about responsible credit use. Teach them the importance of paying bills on time, avoiding high credit card balances, and the impact of credit on their future goals. By taking an active role in your child's financial education, you'll equip them with the knowledge and skills to make informed decisions as they enter the world of credit. Building and maintaining a good credit score isn't rocket science, but it does require some savvy strategies. Here's what you can do. 1. Debt management. Focus on paying down existing debts. Reducing your debt-to-credit ratio can significantly boost your score. 2. Responsible credit card use. Use credit cards wisely. Pay your bills on time, keep balances low, and avoid opening too many accounts at once. 3. Diversify your credit accounts. Having a mix of credit types, like credit cards and installment loans, can be a plus. It shows you can handle different financial responsibilities. Remember, it's all about demonstrating responsible financial behavior to the credit gods. All right, let's bust some credit score myths that might have been holding you back. Closing a credit card will improve your score. Nope, it can hurt it by reducing your available credit. Checking your own score hurts your credit. Not at all. This is a soft inquiry and doesn't impact your score. Carrying a small balance boosts your score. False. Paying your balance in full is the way to go. Income affects your score. Your income doesn't factor into your credit score. It's all about your credit history. Understanding these myths will help you navigate the credit world with confidence. Don't forget to like this video, subscribe to our channel, and turn on notifications. Thank you, and see you on the next one.